Welcome to the deep dive. It is Thursday, January 8th, 2026.
hmm
And if you're tuning in today, you're probably feeling what we're feeling.
Which is
This strange paradox, right? The market indices are soaring, but the anxiety level feels like it's even higher.
that tension is absolutely palpable. And based on the intel hitting our screens this morning, that anxiety is, well, it's probably justified.
So that's our mission today.
Exactly. We're going to give you a shortcut. We're synthesizing a whole stack of sources to define the real risks for Q1.
And we're approaching this as senior risk analysts. We're looking past the daily noise to answer, really, the one question that matters for every portfolio right now.
And that is,
Are we riding some kind of new, sustainable wave of innovation? Or are we just standing on the edge of a valuation cliff? A death zone, if you will.
the data suggests the cliff is a lot closer than the wave. Let's get into it. We got 3 areas to cover. The valuation risk, which is extreme, the inflation surprise that's hiding in the physical economy, and then finally, where the smart defensive money seems to be going.
Okay, let's unpack this right away, because the very first data point is genuinely alarming. I'm talking about the S&P 500 PE ratio.
Which is currently sitting at 30.8.
30.8. I mean, by any historical measure, that is absolute nosebleed territory.
It is.
For those of you who were around in the late 90s, that number should be a screaming siren. We are pricing in total perfection.
Not just for next year. For the next 3 to 5 years of, uninterrupted exponential growth, it's a big bet.
So what does that number actually mean in context for someone who doesn't live and breathe this stuff?
Well, it means investors are willing to pay $30 for every $1 of a company's earnings.
And the historical average is closer to, what, 16?
Exactly. Closer to 16. The only other times we've been this high, this consistently, were late 1999 and just before the 2008 crash.
So there's no margin for error.
0. The second a real recession or a policy mistake happens, those valuations are incredibly fragile.
It's like driving a Ferrari with no seatbelts. It's a thrill until it isn't.
That's a good way to put it.
But it's not just the ratio itself. We have to talk about the market cycle. How long has this party been going on?
And if we connect this to the bigger picture, that's where the historical context gets really dark. Okay. This bull market is now in month 39.
Month 39. Some people hear that and think, great, strong market. But history tells a different story, right?
It tells us the oxygen is getting thin. Out of the last 6 major bull markets, only 2 of them survived past month 51.
Only 2.
So we're statistically entering what analysts call the death zone for this cycle. The runway is getting shorter, just as the valuations are peaking. That's the dangerous combination.
So we've burned through most of our historical time, and we've jacked up the prices to an extreme. Now let's add the accelerant.
Policy risk.
Exactly. The real danger isn't just the height. It's the political pressure cooker the Fed is in right now.
Yes. This is the core conflict. Goldman Sachs is calling it the populism versus capitalism fight.
Break that down for us.
Okay, so on one side you have, a huge political force, President Trump, pushing very, very publicly for aggressive cuts to interest rates.
Which is always popular. Cuts mean asset prices go up.
Right? Populism wants the party to keep going. But on the other side, you have the Fed's actual job.
Which is managing the economy.
And they are wrestling with this really stubborn, sticky inflation that's just sitting there at 3%.
3%.
They can't just cut rates aggressively into that without risking a huge inflation comeback. Capitalism, demands stability.
So why is this moment so dangerous? I mean, the Fed is supposed to be independent.
Because the market believes the political pressure might work. That PE of 30.8 is basically a bet that the Fed will give in.
And if they do?
Massive policy error. They cut, inflation spirals, and they lose all credibility.
And if they don't?
The market, which is priced for those cuts, could have a spectacular tantrum.
Yeah.
A deep, fast correction.
So either way.
The volatility is baked in for Q1. There's almost no way around it.
And that 3% inflation number, it's really the whole story, isn't it? If the Fed thought it was going away, maybe they could cut.
Right, but our sources are pointing to something that says this inflation is a lot more structural, and it's coming from the physical world.
Yeah, this is a crucial pivot. Everyone's obsessed with software and AI valuations. But the real economy, the one with, actual stuff, is showing some pretty violent signs of stress.
And that feeds directly back into that 3% problem for the Fed.
Let's get specific. The thing that really caught my eye this week was the sudden spike in lithium prices.
Yeah, a spike of what, $600 overnight?
$600 For a commodity analyst, why is a move that big such a red flag?
Because it's violent. Lithium usually trades on long-term contracts. A jump like that isn't a fluctuation, it's a shock to the system.
And we know it's tied to Chinese supply crackdowns, but the cause almost matters less than the effect.
Precisely. This price hike is a direct hidden tax on any industry that uses batteries.
So the EV sector.
The EV and the energy storage sectors, yeah. You're the immediate casualties.
All right.
Think about it. When your main input cost jumps like that, your profits just vanish. You either have to eat that cost, which crushes you, or you pass it on to consumers.
Which kills demand.
Exactly. It's cost-push inflation in its purest form.
And this just connects so uncomfortably back to the Fed's dilemma we were just talking about.
It really does. They're hoping inflation is just, the cost of a dinner out.
But this isn't that.
No. The lithium spike proves that inflation is still buried deep in the fundamental building blocks of the new economy.
So it makes it almost impossible for the Fed to justify those aggressive cuts that are being demanded.
It makes it politically and economically irresponsible.
The physical world is basically pouring gasoline on the political fire, and the whole high-tech valuation world is just sitting on top of it.
It's a perfect storm of interconnected risk heading right for us in Q1.
Okay, so we've got nosebleed valuations, a policy minefield, and a physical economy driving up costs. I mean, it sounds like there's literally nowhere safe to hide right now.
Volatility is pretty much a guarantee, yes? But even when the tide goes out, you see where the smart money flows. It flows defensively towards true, indispensable innovation.
And we saw a huge signpost for that just today.
It did.
Here's where it gets really interesting. In the middle of all this chaos, we get a major M&A announcement this morning, January 8th.
CrowdStrike acquiring SGNL.
CRWD buying SGNL.
Right.
And this isn't just another cybersecurity deal. This is a signal about the entire future architecture of the internet.
And about where the next $1 trillion of value is going to be created and protected.
So they're acquiring them to focus on something they're calling agentic identity security. If you're reading the tea leaves, this is the sign that capital is shifting away from, consumer fluff and into hardcore foundational security.
And what's fascinating here is what this tells us about the core shift in technology itself.
Go on.
For the last 20 years, cybersecurity has been about protecting people.
Right. My email, my password, my login, human-centric risk.
Exactly. Are you who you say you are? But with autonomous AI, the whole game changes. It's no longer just about protecting people. It's about protecting the AI agents themselves.
So you're not securing a person with a fingerprint anymore.
No. You're giving an AI its own secure passport and a job description that it is not allowed to deviate from. You have to prove that Agent A is really Agent A and that it's only doing what it's supposed to be doing.
Because these agents are going to be managing critical infrastructure, handling data, making transactions, all at machine speed.
Precisely. And this shift, it confirms we're in a new supercycle.
Okay.
And given the valuation fears we started with, that 30.8 PE, the only truly safe place to hide in tech right now is in that foundational security layer.
Because it's not based on hope.
It's based on absolute necessity. You cannot run your business with AI agents unless you can secure them, period. It's mission critical.
So it's defensive growth. It's not tied to whether people are buying new phones or not.
Exactly. In a world priced for perfection, this is the one area that's priced for necessity. That's the signal from today's M&A. #outro.
Okay, let's just quickly review the landscape you're navigating heading into Q1.
That's a tricky one.
We've got 3 huge risk vectors all hitting at once. 1, extreme PE valuations in the historical death zone.
2, that sticky cost-push inflation coming from the physical world, making the Fed's job harder.
And 3, this mad scramble into agentic AI security, which shows where the real anxieties are.
And the key takeaway for you as a risk-aware investor is about timing.
Okay.
That upcoming Fed meeting, January 27th and 28th?
January 27th and 28th.
That is not just another meeting. Given the political pressure for cuts clashing with the 3% inflation reality, that meeting it's a volatility minefield.
You have to be prepared for some major moves around those dates.
Big, fast moves in stocks and bonds, yes.
So what does this all mean? What's the immediate takeaway for your portfolio?
I think given the extreme risks, the valuation, the policy error potential, our advice as risk analysts has to be simple and defensive.
Which is?
Cash is a position, and right now it might just be the best one.
Preserve your capital. Have the dry powder ready for when that volatility hits.
That's how you navigate the death zone.
So we'll leave you with one final provocative thought to chew on.
It builds on this whole agentic AI shift. If the next big supercycle is all about securing and protecting AI agents, their identities, their actions,
Mm.
what does that imply for companies that are only focused on human-centric digital services?
You mean like social media or streaming services?
Anything designed just for human eyeballs and human fingers?
Mhm.
If machine-to-machine commerce becomes the real engine of the economy, how much capital is going to quietly migrate away from those human-centric platforms?
It suggests they could be facing a long, silent headwind.
A very long one. The agent revolution might be redefining what digital value even means.
A fundamental question to ponder as we head into a very volatile few months. We'll talk to you on the next deep dive.